or good morning, depending on where you are in the world. My name is Francesco Paolucci. I'm professor of health economics and director of the Value and Health Economics and Policy Group. Now we here at the University of Newcastle. It's a pleasure really to have the first talk of the year. In fact, as part of our PhD talks. So VP is I would say is almost a group, a collective that really brings together industry, academia, and by industry we also mean government, mainly dealing with issues that in fact do relate to health and healthcare. But in the world we live in, obviously economics being the underpinning social science that we apply to healthcare issues. In this day and age, we can't really operate without really having a clear view and a clear understanding of the macroeconomic, very volatile macroeconomic setting that's surrounding us. Obviously, this has been partly related to the health emergency, and partly also to strategies put in place to respond to it. We have the honor really to have George, who's been an exceptionally active and productive PhD student with our business school, and luckily he has chosen a topic that is of utmost importance for policymakers, not only here in Australia, but globally. And he will guide us through some of the key issues, of course, that relate to his studies, but go beyond. And in fact, interest also recent work that he has done with European colleagues. George is, apart from being a great colleague and a very talented young economist, is being, I would say, a very active member of VheP in many ways, and more broadly in contributing as a casual teacher, also in our courses in both micro and macroeconomics, and contributing to our discipline in business analytics, economics, and politics. So I warmly welcome George. I will give him the word in 1 second. Before I do that, I would like to welcome all the participants. Of course, there will be a way we need to have a mutual understanding on how to pose questions. So George will talk for approximately 45 minutes. Zephanie will be chairing the session. She's also a PhD with us. You can clearly write your questions in our chat or Q&A functions. Zephanie will monitor that. And towards the end, she will collect the questions and kind of intermediate and ask them for you. This is for obviously ease and fluidity of the discussion. Now, if it is something extremely urgent, I have no problems, but I will leave that to George to handle. You might write urgent in your question, but we're sure that typically that wouldn't be necessary in this particular talk. So without further ado, really, thank you, George, for being with us, and the floor is yours.
Thanks, Francesco. Thanks for the lovely introduction. Thanks for everyone for attending. Hopefully I'll live up to expectations. So I'll just share my screen. Here we go. Okay. Hopefully everyone can hear me and see the screen okay. All right, what I'm going to talk about tonight, or this afternoon, or this morning, wherever you are in the world, is about global imbalances and financial crises. And this is essentially based on my PhD dissertation, which is pretty much complete. It's been handed in, and all I have to do is just some very, very minor corrections, add in a few references, which I'll do in the next week. And then that will be that. So for the next sort of 45 minutes or so, I'm happy to answer during the session any sort of urgent questions as Francesco outlines. You can just write me a message in the chat. Okay, so what am I going to talk about? I'm going to explore why global imbalances occur and persist across the international monetary system. And since, I guess, probably before the First World War, there's been numerous monetary regimes adopted to try and correct those imbalances. So we had, for instance, prior to the First World War, we had what was called the gold standard, or it was what was called the classical gold standard. So this one here. After the First World War, so in the interwar years, there was another gold standard that was adopted. After the Second World War, then we had what was called the Bretton Woods system, which lasted until 1971. And then we had in the late 70s, a lot of European countries, prior to adopting the euro as their common currency, they formed what was called the European monetary system, which eventually collapsed in 1990. There was a huge crisis, sorry, in about 1992, 1993, which I'll touch on toward the end of the presentation. So to understand really why global imbalances occur and persist, I'm going to adopt a framework of what I'd call institutional practice. And I've purposely sought out, so in my publications and in my research, not to sort of adopt a particular school of thought. So for those of you that are unaware, in economics, probably like most disciplines, there's particular schools of thought, of economic thought. Whereas I've sort of tried to adopt a sort of a way in which to try and understand how real world institutions actually operate in the real world. So whether that could be a central bank or commercial banks. And I actually reached out to a lot of central bank practitioners and a lot of banking practitioners to ask them questions and get feedback and all those sorts of things. So I'm going to adopt tonight a framework of institutional practice. I'm also going to show a few what I would call flow of funds representations, just to show how payments are actually done through the banking system. And I'll do that by showing a flow of funds representation of cross-border payments through a system of financial accounts. And I'll also show how central banks implement what I'd call foreign exchange operations, so resisting appreciation and depreciation pressures on the exchange rate, and also how monetary policy is actually implemented. I'll then conclude by arguing that there's essentially no sort of automatic mechanism to correct global imbalances. On the one hand, economies that are exposed to what I'd call balance of payments difficulties are subject to what I would call numerous involuntary constraints. However, when a country is running what's called a current account surplus or a trade surplus or an overall balance of payments surplus, where the central bank is accumulating foreign exchange, those sorts of challenges can be circumvented very, very easily. And that includes instances where policymakers try to implement what I'd call independent monetary policy and heavily manage the exchange rate while remaining open to global capital flows. And that's in economic terms what we call the Impossible Trinity, so which is based on this triangle here. So for instance, if policymakers try to fix the exchange rate and maintain independent monetary policy, then according to the Impossible Trinity, they have to give up what I'd call free capital flows. Okay, that's what the Impossible Trinity is about. So what are global imbalances? Global imbalances are essentially current account or overall balance of payment disequilibria. So you may have heard of current account deficits, where that's essentially a trade deficit where a country's importing more than what they're exporting. You may not have heard of balance of payment disequilibria. So if we actually look at the balance of payments identity, we've got the current account plus the financial account minus changes in stocks of foreign exchange reserves. So a country, for instance, could be running a current account deficit, but it turns into a balance of payments crisis where the central bank starts losing large amounts of foreign exchange reserves, okay? And I'll touch on that as I go through the talk. So why is it important to actually study global imbalances? And this is a question which I thought about at great length during my PhD. So suppose, for instance, a nation is constantly running current account deficits. In other words, they're importing more than what they're exporting. And as we'll soon see, this actually means that the nation's external liabilities are increasing. In other words, banks, domestic banks are becoming indebted to foreign banks due to what we call the cross-border interbank market. Okay, so in other words, if you look at, and I'll show you in a minute, a graph, the nation as a whole, in terms of the private sector, the banking system is becoming indebted to overseas banks. Okay, and that's the issue with current account deficits. All right, and that can turn very, very quickly into what we call a balance of payments crisis. Okay, just very quickly, the identical can also occur through what we call the financial account. So if, for instance, large companies start getting rid of their deposits through domestic banks and transferring them to foreign banks overseas, again, the nation will becoming, or the domestic banking system will be becoming indebted to overseas banks. Okay, that's what we call an IOU. So if we look at a graph, for instance, so I've just picked Australia, just for argument's sake. This is Australia's net debt versus the rest of the world. In other words, when we say net debt, right, this is private debt. So this is debt through the banking system. And as you can see, this is from around 1988 to August 2021. So this is from the Australian Bureau of Statistics. Generally, over the previous few decades, Australia has run current account deficits. They've only very, very recently been running current account surpluses. So you can see the Australian banking system is becoming indebted to the rest of the world, with the exception of this little period here. And that's because Australia has been running current account surpluses, okay? However, if we look at this sort of graph, we can see Australian banks are becoming indebted to the rest of the world, to foreign banks. There's always a limit to which an agent, or in this case a bank, can become indebted to creditor banks, okay? There are some exceptions, right? Some exceptions, which I'll explain later on, is if, for instance, your domestic economy essentially uses what we call the global reserve currency, in other words, the US dollar, okay? But if we suppose this isn't the case, the domestic economy can suddenly become subject to what we call a sudden stop. In other words, domestic banks can't become any more indebted to foreign banks, right? And that source of liquidity suddenly gets shut off, right? And so to actually finance current account deficits, it becomes very, very difficult. And typically, the chain of events is you get rapid exchange rate depreciation, right? And because of what we call rapid exchange rate depreciation, we get huge inflationary pressures in the domestic economy. As a result of that, then we get large amount of what we call a bank run, right? Where everyone is basically running to domestic banks to try and withdraw cash and convert it into foreign currencies. And in the extreme, banks can actually default, right? And it causes all sorts of instability in the macroeconomic context. And this has happened time and time again throughout history. So just some recent examples. In 1992 and 1993, we had a massive crisis within what was called the European monetary system. In particular, I don't know if anyone's heard of George Soros, who speculated against the British pounds, and that caused huge amount of instability in Britain. It also occurred in Italy as well, Portugal, Spain, in the early 90s. So that was called a balance of payments crisis. 1994 in Mexico, 1997, you had the Asian financial crisis. And the very recent one, which I've been following very closely, is in Turkey. Okay, if we actually consider Turkey as a bit of a case study, this is the exchange rate of the Turkish lira against the US dollar. So what this graph is showing is that it's taking more and more Turkish liras to buy $1 US. So we can see in about 2014, it took 2 Turkish liras to buy $1 US. But now, because of a chain of events where Turkey is suddenly becoming engulfed in what I'd call a balance of payments crisis, it's taking, give or take, around about 14 Turkish liras to buy $1 US. Okay, the Turkish lira is becoming very, very weak, right? And that causes huge amounts of inflation. Generally, to choke off inflation, domestic policymakers have to either implement fiscal austerity measures, in other words, the government has to cut spending, or the central bank has to raise interest rates to basically put a choke on inflation. And that causes huge amounts of domestic macroeconomic instability. Unemployment will generally rise. There'll be generally a bank run. So I don't know if you saw on the news, people in Turkey were running to the bank to withdraw Turkish liras and exchange in cash and exchange it for US dollars. And that causes all sorts of issues for banks as well, okay? To actually offset those depreciation pressures, the Turkish central bank of late has been trying to resist those depreciation pressures. And the way central banks do that is through selling foreign currencies and buying up domestic currencies. So in this particular case, Turkey, this is a graph showing you the amount of foreign exchange reserves on the central bank balance sheet of Turkey. You can see here, it's dropping off very, very rapidly. What the central bank of Turkey is doing is they're essentially buying up Turkish liras and selling US dollars, okay? But the issue is there's a limit to those sorts of processes. In other words, the Turkish central bank, just like every other central bank in the world, can create an unlimited amount of Turkish liras. So for instance, in the Australian context, the RBA can create an unlimited amount of Australian dollars. It can never default in anything in Australian dollars. However, central banks only have a finite amount or a finite stock of foreign exchange reserves. So in this particular case, if the Turkish central bank is selling foreign exchange reserves to try and stop the exchange rate from plummeting, there are limits to the degree at which it can do that, okay? If we look at another little example, this is the case of Argentina, okay? So this is from around 2014 to 2022 to the current rate. You can see it's taking, so in 2013, 2014, it took around 10 pesos to buy $1 US. Now it's taking over 100 pesos to buy $1 US, okay? Again, causes huge amounts of inflation and domestic macroeconomic instability. So what's the Central Bank of Argentina been doing? They've been trying to resist depreciation pressures through selling US dollars and buying up pesos. But again, there's limits to the amount that the Central Bank of Argentina can do that. All right, so let's have a look at a very, very simple representation of a cross-border payment. So most people, obviously we do thousands and thousands of transactions generally in our apps on our phone, but a lot of people don't actually stop and think, well, how is it actually going through the banking system? And my thesis was concentrating on the cross-border aspect of it. So I started actually looking at how banks actually execute cross-border payments. So if I'm buying something from overseas, so if I'm buying, for instance, this phone, if I'm importing this phone from overseas, how is my bank actually doing that? Okay. And I started looking into it and I found there wasn't a lot of literature on this sort of topic. And that's when I started actually thinking about how is it actually done. And then I sent a document to various people within the banking and central bank industry and realized I was on the right track. So the way banks actually do it is they actually maintain deposit accounts with one another to facilitate cross-border transactions. In other words, it's through these what we call a nostro and a vostro account. So it's through a system of what's called correspondent banking. In other words, one bank, the correspondent, holds deposit on behalf of another bank, the respondent, okay? So for instance, if I'm buying something from the US, which is invoiced in US dollars, my bank, let's say it's the Commonwealth Bank, will have a relationship with an American bank, and the two banks will hold deposits on behalf of one another, okay? And we'll see that in a moment. Typically, though, correspondent banking is done through very, very large banks. So in my own personal case, I bank with the Newcastle Permanent. The Newcastle Permanent can't actually do cross-border payments on its own accord, okay? It actually relies on the big four banks in Australia, okay? Because the Newcastle Permanent, with all due respect to it, in the grand scheme of things, isn't a very large bank, it has to rely on the CommBank, the ANZ, Westpac, or the NAB to do a cross-border payment, okay? Part of the reason that is there's significant costs associated with cross-border payments, particularly in the realm of they have to sort of comply with a large amount of regulation, so anti-money laundering and counter-finance terrorism checks. And this adds a lot of costs, okay? All right, let's have a look at a very, very simple example, and then I'll move on to a slightly more complex one. Let's assume that nation A incurs a current account deficit in the amount of A, so just some arbitrary figure. Okay, so in other words, agents, so it could be myself, in nation A are buying an import, right, or buying a product from nation B, and it's actually invoiced in currency B. Okay, I have to pay for it in currency B. How it is actually done. So this is my bank here. Here I'm assuming the most simple case, just a very, very simple, what I'd call a bilateral relationship. So you can see by looking at the financial accounts, my bank, right, bank A, has what I'd call a nostro account, right? This account here, a nostro account. If we look at bank B, the same account is actually what I'd call the vostro account, this one down here. And this is the same account, okay? It's on the asset side of bank A, right? But from bank B's perspective, it's held on the liability side, because in accounting, assets always have to equal liabilities. So how does the cross-border payment executed? My bank will actually debit my deposit account, this one here, and bank B will actually debit the vostro account of my bank. Okay, so you can see here, the vostro account has been debited by minus A, which results in the nostro account of bank A, right, decreasing. And so after that is done, so my account's been debited, the account of the export, in other words, the person in nation B, right, their account gets credited, okay? So all of a sudden now there's a cross-border payment that's happened through the banking system, okay? And this is actually done in what I'd call commercial bank money, because it happens on the liability side of the balance sheet of the bank, okay? Most domestic payments are actually now done in what I'd call central bank money. In other words, they cross the books, so to speak, of the central bank. And that's actually the safest form of payment. There are risks involved in this because potentially, for instance, my bank, Bank A, could debit my account, and in the process of completing the payment, Bank B could be declared insolvent, okay, and the payment won't go through. There's no chance of that happening with the central bank, okay, because it's passing across the books of the central bank, and by definition, central banks can't default, okay, for domestic payments. All right, so hopefully that's very clear to everyone. That's key to actually understanding what I'm just about to talk about. So after that has happened, so after the cross-border payment has been executed, okay, Bank B, right, the bank of the exporter, will immediately loan those funds back to Bank A. So we can see the original payment is in red, so minus A here in red, minus A here in red, plus A for the deposit account of the exporter, right, and minus A, this is the vostro account or the nostro account of Bank A, right? So after the cross-border payment has been executed, right, Bank B will immediately loan those funds back, right? And that's done through what we call the cross-border interbank market. So I'm assuming here that Bank A and Bank B have a very close relationship with one another, okay? And this actually happens automatically. And so you can see because Bank B has actually loaned those funds back, it simply credits the vostro account of Bank A. And so now Bank A has increased its nostro account deposits back to its original level. I should have mentioned before, this is actually denominated in foreign currency, this account. Okay, so this would be currency B deposits. Okay, because remember, the import, so my purchase of the phone from overseas or whatever it is, the product, is being invoiced in currency B. All right, and because Bank B has loaned that amount back, it actually accumulates a claim, right, or what we call an interbank claim on Bank A, right? From my bank's perspective, Bank A incurs a liability, right, to Bank B. And all of a sudden, because of that, Bank A is now become indebted to Bank B. Okay, so remember the graph I showed you before of Australia's net debt vis-a-vis the rest of the world? This is because of in part, because of the operation of the cross-border interbank market. Okay, so you can see here, Bank A has a liability now to the rest of the world. In this case, it's Bank B, right? And this is representing a current account deficit. So if, in this case, nation A is constantly running current account deficits, right, you'll get this sort of thing happening, right? We're domestic banks are becoming indebted to the rest of the world. If we look at these transactions from the purpose of balance of payments accounting, remember, nation A was importing something. I was buying a phone or whatever it is from nation B, right? So if we look at the balance of payments identity, we can see that nation A has incurred a current account deficit, which is offset through what I'd call a financial account surplus. So minus A plus A, and that equals 0. So the central bank isn't involved in this transaction at all, right? It doesn't have to intervene to offset appreciation or depreciation pressures whatsoever, okay? Banks have handled it amongst themselves. Why is that? Because Bank B is willing to extend the loan to Bank A, okay? And then Bank A is able to becoming more and more indebted to Bank B. So from the perspective of nation B, it's running what I'd call a current account surplus, and it's running a financial account deficit. And again, there's no change in stocks of foreign exchange reserves at the central bank. Okay, hopefully that's clear to everybody. All right, note the direction of causality. I'll just go through this very, very quickly. So nation A has posted a current account deficit first, which is then offset by a financial account surplus. This is actually in contrast to a statement by Ben Bernanke, who was the chairman of the Fed for many, many years, including during the global financial crisis. And what Bernanke was arguing just before the GFC, Bernanke was saying that the current account deficits of the US were actually being financed, quote unquote, by the current account surpluses of China, okay? But in my opinion, this is actually very, very misguided. Okay, notice in my particular example, right, the current account, nation A is actually posting a current account deficit first, which is then offset by financial account surplus. In other words, the excess savings of nation B, right, its current account surplus, aren't actually being, in a way, recycled to nation A, right, to fund the current account deficit from nation A. Okay, so outside of any stress sort of scenario, when banks are willing to trust one another and the interbank market is very, very fluid, right, current account deficits are automatically offset by financial account surpluses, which I showed in this particular example here for the balance of payments account. All right, very, very quickly, let's have a quick look at how monetary policy is. So we've looked at how cross-border payments are done. Let's have a quick look on monetary policy. So contrary to a lot of macroeconomic textbooks, the central bank actually doesn't control the overall money supply. Okay, what the central bank is actually doing in terms of its monetary policy is it's actually steering what's called the overnight interbank rate, and that's the rate at which banks lend reserves to one another through the domestic interbank market to its choice of policy rate. So in the context of Australia, the policy rate at the moment of the RBA is 0.25%. Okay, so the RBA, what it has to do is actually steer the overnight interbank rate, right, which is the rate at which banks lend liquidity to one another, to 0.25% every single day, okay, every single day of the year. If there's an excess supply of reserves, the interbank rate will start to fall, okay, because there'll be an excess supply. So what happens? The price falls, and that's reflected in the interbank rate. If there's an excess demand of reserves, then the interbank rate rises, okay, just through basic laws of supply and demand. The central bank, so in the Australian context, the RBA is actually removing or injecting reserves through what's called open market operations. Okay, so it's trying to get rid of the excess supply of reserves or inject reserves to get rid of the excess demand. And the RBA does this pretty much every day through what we call open market operation. And what an open market operation is the RBA is, for instance, if it wants to inject some liquidity, right, into the banking system, if there were to be an excess demand for reserves, the RBA starts buying assets off banks, and it's typically government debt, right? So the RBA buys assets off banks and in return gives banks more liquidity, okay? If the central bank actually makes an error with respect to the degree at which it must implement open market operations, at the end of the day, banks can actually access what's called a lending or deposit facility of the RBA, okay, which we'll see on the next slide. Okay, so again, just to emphasize the point, central banks don't control the overall money supply. Right? If you go to a bank and get a loan, the bank will actually just create the loan out of thin air. The bank actually doesn't need any of your deposits to make a loan to you. Okay, it actually just makes a loan just by writing an entry into its ledger. Nowadays, it'd be done by keyboard. Okay, and just if you think I'm lying, just ask anybody in a central bank, and I know because I did. Okay, so this is actually pre-COVID-19. This is what I'd call a corridor system. So remember when I was talking about the RBA, or a central bank, must steer the overnight interbank rate to its choice of policy rate through a corridor system. This is straight off the RBA's website. This is the representation of a corridor system. So we've got the demand curve for reserves and a supply of reserves. And the RBA can supply an unlimited amount of reserves, which is why the supply curve's vertical. It's perfectly inelastic. Okay, so if there were to be, for instance, an excess supply of reserves, right, this supply curve would move to the right, right? And where supply equals demand would be here. And so at the moment, the cash rate target of the RBA is 0.25%, right? So if there were to be an excess supply, the cash rate or the interbank rate would start falling, right? And then what the RBA would do through open market operations is try and remove that excess supply and shift the supply curve back to the left. If at the end of the day, the RBA's made some sort of mistake, right, to the extent at which it must implement open market operations, banks will actually deposit excess reserves in the RBA's deposit facility. Okay, so this is very, very quickly, just a quick graph of what the RBA is actually doing. The orange line is showing you what the RBA is doing, and the blue bits, so the blue bits here, is showing, for instance, what the private sector is doing. And the RBA every single day has to offset what the private sector is doing. So you can see, for instance, here, during the initial stages of the GFC, the RBA was implementing liquidity injecting operations. In other words, they were pumping money into banks. And why is that? Because the amount of currency in circulation, if you really want to know, was going up. People were running to ATMs and withdrawing cash. And so the RBA had to offset that. Okay, let's have a look now at, we're getting to the sort of the crux of the argument. Remember, we're trying to work out why global imbalances occur and persist. Let's suppose that there are two economies, nation A and nation B, just like before. Let's also assume that cross-border payments are denominated in US dollars. So the US dollar actually still acts as the global reserve currency. Okay, so about half of global trade is still invoiced in US dollars, including in Australia. So some Aussie exports, they're sold in US dollars as opposed to Aussie dollars. So because all cross-border payments are denominated in US dollars, and we're saying or assuming both nation A and nation B are operating under some sort of fixed exchange rate regime, both countries must manage the price of their currencies in according to what I'd call the bilateral cross-exchange rate. And this is the formula here, okay? A cross-exchange rate is essentially an exchange rate which doesn't involve the US dollar, right? So if you look at the Australian dollar versus the New Zealand dollar, right? That's an exchange rate which really isn't used much in international banking. Usually, exchange rates are compared against the US dollar. And so if we wanted to compare the exchange rate of the Australian dollar versus the New Zealand dollar, it would be done via the US dollar. In other words, the bilateral cross-exchange rate. And I've just used some figures just to represent this, or some letters. So beta, right, is this part here, and mu is this part here. So beta is the number of currency A units required to purchase $1 US, okay? This one here. Conversely, mu is the number of currency B units required to purchase $1 US. This one here, right? So if you go through the maths and just do the basic simple sort of equation, you get this guy here. In other words, it's just flipped. So beta divided by mu. So from the point of nation A, beta divided by mu is the bilateral cross-exchange rate. In other words, it's the number of currency A units required to purchase 1 unit of currency B. Alternatively, mu divided by B is the cross-exchange rate from the perspective of nation B. which is the number of currency B units required to purchase 1 unit of currency A. So remember, these two countries are operating under a fixed exchange rate system. Okay, they have to manage their exchange rate or the price of their respective currencies against one another. Okay, so for instance, by intervening in what we call the spot market for US dollars, right, nation A or its central bank must attempt to maintain the cross exchange rate at beta divided by mu. And conversely, on the other hand, nation B must preserve a cross exchange rate of mu divided by B. Should something happen and the cross exchange rate deviates from its initial equilibrium where supply equals demand, right, the central banks of both countries are going to have to intervene, right, to nullify either depreciation or appreciation pressures. So if we look at this diagram, for instance, this is from the point of view of nation B. And we can see we've got our initial equilibrium, right? If, for instance, the supply of foreign currency, in other words, currency A, were to increase, the supply curve would shift to the right. And this would be my new equilibrium down here, where demand equals supply. And that's actually the upper limit of currency B and the lower limit for currency A. In other words, central bank B will have to try and resist appreciation pressures, so its currency is getting stronger. And central bank A will have to limit depreciation pressures. Its currency is getting weaker. So let's have a look at how that is done. So again, we're assuming again, like before, nation A incurs a current account deficit with nation B of A, and it's denominated in US dollars. This is a little bit more complex example. So from the point of view of nation A is equal to beta A. And from the point of view of nation B, A is equal to mu A. Okay, so again, the central banks of each country have to monitor what's going on with their exchange rates, and they have to manage their exchange rates. Unlike before, in the little first example I showed you, where I assumed that Bank A had some foreign currency deposits, in other words, some nostro account balances, in this case, it does not, right? And because nation A in this particular example has been running current account deficits for a large period of time, Bank B isn't very willing to extend any loans to Bank A, sorry. Okay, so Bank B isn't willing to extend any loans to Bank A. So, but Bank A doesn't have any US dollars on its books. So what does Bank A do? To finance the current account deficit, Bank A actually has to enter the foreign exchange market. And the way it does this is it tries to offload a stock of currency A reserves for US dollars. And that depreciates currency A against the US dollar. But that actually means by definition that the cross exchange rate, right, the exchange rate between nation A and nation B is affected as well, okay? And that is just shown through this diagram, which I explained previously. So this is from the point of view of nation B. The supply of foreign currency, in other words, currency A, has increased or it's shifted to the right. And so now we're at this point down here. And so what has to happen now is central bank A has to try and resist depreciation pressures, in other words, stop its currency from getting weaker, and central bank B has to try and stop its currency from getting stronger. The way it's done, right, so central bank A has to resist depreciation pressures, has to stop its currency from getting weaker. What it does is it purchases the currency A, which Bank A is trying to get rid of, and it sells US dollars to Bank A, okay, which is actually done across the books of Bank USA, which is a bank I've just made up. So we can see in this particular example, central bank A is selling US dollars, right, to Bank A, right, and Bank A is getting rid of some currency A reserves, right, and that's actually factored in on the balance sheet of central bank A. So this account here is the same account. Okay, so banks, for those of you that aren't aware, banks actually hold deposits with the central bank. Okay, so this is accounted for on the books of Bank USA, right? So in other words, what Bank USA is doing, all the banks are communicating with one another in a messaging format, which is called SWIFT, right? And Bank USA is actually debiting the Vostro account of central bank A and crediting the Vostro account of Bank A. And at the end of the day, when all's said and done, Bank A now has some US dollars on its books, but it's lost some currency A reserves. Right? Remember, central bank B has to resist appreciation pressures, and it does so through purchasing US dollars from Bank B and selling Bank B some currency B, and that's also done on the books of Bank USA. So in other words, right, Bank B is getting rid of some US dollars, and in return, it's getting some stocks of currency B, right? And this is done on the books of Bank USA, right, through Zwift, the messaging service. And so what Bank USA is doing is it's debiting the Vostro account of Bank B, and it's crediting the Vostro account of Central Bank B. So in a nutshell, when all's said and done, Central Bank A has resisted appreciation pressures, and it's ended up accumulating some US dollars. Bank B, on the other hand, has lost some US dollars, but it's accumulated some stocks of currency B, which is in this account here. Okay, so now the cross-border payment is completed, like I showed you right at the beginning. So Bank A, its customer, right, is buying an import from Bank B, which is, so its deposit account is debited, its stocks of US dollars fall through there, and it's represented in the green color, right? Its stocks of US dollars fall, and this is done across the books of Bank A. I'm just conscious of time. It's done across the books of Bank A. And what ends up happening is the customer of Bank B ends up with some US dollars on its books in its account, and Bank B ends up with some US dollars as well, okay? So from the point of view of balance payments accounting, right, Nation A is currently running what we call a balance of payments deficit. So it's running a current account deficit, and the central bank has lost foreign exchange, right? And in this case, US dollars. Conversely, from Nation B's perspective, it's running a current account surplus, and its central bank has accumulated US dollars, okay, as a happy side effect. Remember, though, that central banks are actually looking at what's happening in terms of reserves and what's happening to the interbank rate. So in this particular example, Bank A has actually lost reserves. Okay, so if you look at the example, Bank A has lost reserves. Bank B has gained reserves, which are these ones here. Bank B has gained reserves, and Bank A, sorry, this one here, has lost reserves, right? All else being equal, what's going to happen is the interbank rate in Nation A is going to rise because there's an excess demand. And in Nation B, right, the interbank rate is going to fall because there's an excess supply. So both banks have to intervene again through open market operations. Otherwise, their monetary policy is compromised. From the point of view of Nation A, right, there's a variety of ways this can happen. In other words, there's a variety of ways at which the central bank can inject more liquidity. But it can do an open market operation on its own initiative, right? Remember, as I mentioned before, that's fine, but Bank A has to post some securities as collateral, okay? So the central banks just don't give out money willy-nilly. Banks have to post generally good quality collateral, and it's generally government debt. So in this particular case, the reserve deficit, in this particular case, Nation A, is what I'd call exogenously sterilized. It's the central bank is doing it. If the central bank made a mistake and didn't realize it had to do any open market operations that day, right, Bank A at the end of the day will seek recourse to the lending facility of central bank A, and the reserve deficit will be endogenously sterilized. In other words, the reserve deficit is being eliminated on the initiative of Bank A, as opposed to central bank A doing it. And if we run again through the accounts, again, I'm just conscious of time, this is what the accounts would look like. Okay, so Bank A has rebuilt its stocks of reserves at the central bank, right, by selling the central bank some securities. The central bank has purchased some securities, and in tandem has given or has credited the deposit account of Bank A. However, remember, Nation A has just run a balance of payments deficit, right? Remember, central bank A has a limited amount of US dollars on its books. It can't stop depreciation pressures on the exchange rate forever, right? There's a finite limit to which it can do this. On the other hand, as I explained, to get that greater amount of reserves on its books, Bank A has had to post some securities, right? Now, if Bank A doesn't have good quality securities or good quality collateral on its balance sheet, it won't be able to get more liquidity, right? And in actual fact, what will happen is it'll create a bank run. So I don't know if you remember in Greece in 2015, the European Central Bank actually stopped accepting collateral from Greek banks. So banks in Greece, domestic banks, couldn't get any more liquidity. And then people realized what was going on and ran to the bank to try and withdraw their deposits into cash. Okay, and this will create a bank run. And that leads into domestic macroeconomic instability. So there are very fine or severe limits to what nation A can do in this particular context. Okay, in the context of nation B, right? Remember, Bank B had a reserve excess. So the central bank in nation B has to get rid of that reserve excess. The central bank can do this through a variety of ways. It can sell government debt through an open market operation to Bank B. Central banks in a lot of countries which have run large balance of payment surpluses, they're actually, the central banks in those countries have run out or starting to run out of government debt. This is pre-COVID-19. They're starting to run out of government debt to sell to their domestic banks. So they're in those countries, Thailand, Indonesia, South Korea, Malaysia, the central banks are actually issuing their own what we call central bank securities. They're issuing their own form of debt to try and get rid of the reserve excess. The central bank can also get rid of the reserve excess through what I'd call non-marketable instruments. So it can increase minimum reserve requirements and a variety of other measures it can do. And so the reserve excess in Bank B in this particular case will be exogenously sterilised. If the central bank, so in this case, central bank B, made some sort of mistake and it didn't realise it had to get rid of the excess liquidity on that particular day through an open market operation, Bank B can deposit its excess reserves in the deposit facility of central bank B. In other words, the reserve excess will be endogenously sterilised. So unlike in nation A, there's no limit to the extent to which central bank B can resist appreciation pressures on its currency, and there's no limits to the way in which central bank B can get rid of the reserve excess. And just to finish up, I'll show you a quick little example. So in the early 90s, right, the European monetary system was the precursor to the Eurozone. So a lot of European countries got together and decided to manage their exchange rates against one another. During this period, Germany and the Netherlands were running quite large balance of payment surpluses. And countries like, for instance, Italy, France, Portugal, Spain were running quite large balance of payments deficits. If we look at Germany, for instance, this is 1992. The grey is showing the change in central bank foreign reserves on its balance sheet. So in this particular case, the Bundesbank was actually accumulating huge amounts of foreign exchange on its books because it was resisting appreciation pressures on its currency. Right? Similarly, in the Netherlands, showing 1992, this one here, right, it was resisting appreciation pressures on its currency. And as a happy side effect, right, it was accumulating large amounts of foreign exchange on its balance sheet. Right? Remember, when the central bank accumulates or resists appreciation pressures on its balance sheet, it has to get rid of the reserve excess. And the German Bundesbank did a variety of different initiatives to get rid of the excess reserves. I won't go through them all, but just because of time. And same in the Netherlands. Okay, so they always found a way to get rid of those excess reserves. Right. Conversely, countries like, for instance, I didn't mention Britain in 1992, the Bank of England was heavily resisting depreciation pressures. So everyone was speculating against the British pound. And the Bank of England had to try and resist depreciation pressures on its currency. Okay. And eventually it started actually running out of foreign exchange. And so it actually exited the European monetary system, never to return. And that's one of the fundamental reasons why Britain didn't adopt the euro. So we can see here in Germany, for instance, in the 92-93 European monetary system crisis, the negative orange value, so this value here, means that the central bank is getting rid of excess reserves. And you can see when you compare it to all the other values, there was a huge amount of activity going on. In other words, the German Bundesbank was withdrawing huge amounts of excess reserves after resisting appreciation pressures. And there's no limit to what to these sorts of processes. Okay, central banks can always, no matter what, always resist appreciation pressures, right, and get rid of the excess reserves. On the flip side, countries which are succumbing to balance of payments issues, so like the one I showed you right at the beginning, so for instance, the Turkish lira, right, the central bank will actually, one, run out of foreign exchange eventually, and B, banks will actually start suffering from collateral constraints. They'll start actually running out of good quality collateral to try and get back those lost reserves, right? And if they start running out of good quality collateral, it'll force a bank run. So, in conclusion, my thesis basically concludes, or tonight I conclude, that there's no sort of automatic mechanism to rectify global imbalances, right? And this has been shown time and time again. If you actually go, which I did in my PhD, I went back through all the monetary regimes in the past 100 years or so, and you can see countries that are running either current account surpluses or balance of payment surpluses, and as a byproduct where their central bank is resisting appreciation pressures on their currency, right? There's no limit to the extent to which a central bank can actually resist appreciation pressures, okay? So there's no sort of automatic mechanism to actually rectify imbalances within the global economy. That's the sort of crux of my thesis, is trying to essentially show. And this actually includes instances of where policymakers manage the exchange rate, run independent monetary policy, and remain open to global capital flows. So in other words, the impossible trinity can actually be circumvented, okay? So as long as the central bank is accumulating foreign exchange, in other words, resisting appreciation pressures, the impossible trinity doesn't really impose any constraints on domestic policy. Conversely, if the domestic economy is running a balance of payments deficit, then the impossible trinity definitely holds true, okay? There are severe limits on domestic policy making when countries are running either current account deficits or balance of payments deficits, which we're seeing time and time again. So in conclusion, I hope I've convinced you that global imbalances are actually very difficult to rectify, and this is why they can persist. Okay? Thanks for listening. I'm happy to answer any questions.
Thanks, George.
You're welcome.
Wow. So I'm stepping in to chair this part of the session for Francesco. And I think I'll just start by saying, I think you've set the bar high for the PhD talks for the year. Our intention is to hold one of these PhD talks every month. And so I think you've set the standard for all of us, me included. So I've just asked everybody to put their questions in the chat. I don't see any yet, but so now's a good time for you to put those questions in there and take advantage of having George on the line. George, as we were talking before the session, I'm not an economist. I've learned a lot through your talk, but my question is more, I'm going to start with a question just to get people going, is more about what your intention was here. So you kind of said that the literature was pretty quiet on cross-border payment arrangements. And so I'm just wondering, was it your intention then to really try to demystify that? And in doing so, you really have identified that there really isn't a mechanism to rectify the global imbalances. Is that kind of it? And you know, not meaning to make it sound small at all, because it sounds incredibly complicated to me, but was that your intention? And in doing so, what impact are you hoping to have?
So yeah, when I originally sort of started thinking about my thesis topic, when I started thinking, because I've always had an interest in history. So I read a lot of history books and stuff, just about the Second World War and previous to that. I started actually coming across all these different monetary regimes, and I noticed that global imbalances have never been rectified. And I started thinking about, well, why is that the case? And so to actually answer that question, I started thinking about, well, if I'm actually buying something from overseas, how is it actually done? And so that led me down the path of trying to look at in the literature, because there is a lot of literature on global imbalances. There's a huge amount of literature, but I found that there's virtually nothing on looking at from the perspective of how transactions are done through the financial accounts. And so then I started looking at how cross-border payments are done. And then I very quickly started thinking about, well, if I adopt a sort of flow of funds framework, I can actually show what banks are doing, what the central banks are doing, how central banks implement monetary policy, what sort of constraints economies can succumb to. Are economies, for instance, that are running a balance of payments surplus subject to any constraints? And then I started thinking about, well, is there sort of any sort of automatic mechanism to try and rectify those global imbalances? And my argument through my thesis is no, there isn't. And so that's why I came to the conclusion of, well, there's no sort of automatic mechanism, and I proceed through the thesis and hopefully tonight to show why that is the case. So I sort of, I guess in a nutshell, I stumbled on it by accident because I started looking around thinking, well, okay, is this the way it happens? And I actually just got a bit of paper and wrote some balance sheets out, and I sent it to someone at the European Central Bank and the Bank of England, thinking that they probably would never get back to me. And then within a few hours, they both got back to me and said, yes, that's the way it's done. And then they actually sent the document to someone at the Bank of International Settlements, which is sort of like the central bank for all central banks. And had a bit of correspondence with a few people there, and everything just sort of flowed from there, I guess. Does that answer your question?
Yeah, mostly. And you touched on my other question, which I might as well keep going since there's not another one in the chat just yet. And that is, I was going to ask you, you said you talked to, or you sent some of your ideas to some of these central banks and the Bank of England you've just talked about as well. And you got a warm response, Yeah,
it was, so yeah, that was really surprising. And it's, for any of the PhD students listening, I'd strongly encourage you to send emails to everyone. Anyone that you can, send an email to. Most people, they'll respond in a very warm manner, and they'll be happy to help you. So yeah, I was very, very lucky. I've been very, very lucky that in particular, one person at the European Central Bank got very interested in what I was doing. And then we started talking on Zoom, as everyone does now. He's based in Frankfurt in Germany. And so now we're writing a book on payments and all these sorts of things and all the market infrastructures which facilitate payments. And so that led to me writing a couple of papers and then him putting some ideas forward. And then we ended up writing them together, which is in addition to my thesis. And then next month I'll be presenting those at the ECB at probably about 3 a.m. and so.
That's fantastic. Thank you.
You're welcome.
I'm not seeing any other questions. Are you seeing?
Oh, that's okay. I've probably talked too much. Everyone's probably.
Well, I think we are coming up to the hour, so maybe we will close and wish you well with those next endeavours with your PhD, but also those next endeavours that you just talked about. As I said, you've set the bar high. Thank you very much.
Thank you. Thanks for listening, everyone, and. Yeah, hopefully we'll see each other in person very soon.
Yeah, and just for those on the call, as I said, we're going to have one of these every month. So if you see the invite or you see the promotion, please share it with your friends, your colleagues, and ask them to attend. I think we're going to see some really interesting talks through the course of the year. And thanks, George, for showing us the way.
I just noticed just quickly, I got a message. George, can we connect you on LinkedIn? I'm assuming you guys LinkedIn. I'm actually very old-fashioned. I don't use actually any social media. If you want, I'll put my email in the chat, and you're more than welcome to email me and get in touch. I know it's very surprising that a lot of people are a bit shocked when I tell them I don't use any social media. All right, thanks everybody.
Okay, thanks everyone for attending.
Bye-bye.
See you soon.